12:37. We're going to start special meeting, Calexico City Council, Calexico Redevelopment Successor Agencies, Calexico Financial Authority special meeting. The call to order. Ms. Erica, call to order.
Here. Here.
Kim is here.
Just note the attendance.
Mr. Castro just walks in. Okay. Okay, we have 4 members, and we have quorums, and we're going to start the pledge of allegiance, led by Mr. El-Mushia, please.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, approval agenda.
So moved. Second.
Motion by Mr. Romero, second by Mr.
Moreno.
Mr.
Romero.
I'm sorry.
Aye.
Aye. Okay, public comment and the public appearance. Note, not to exceed 3 minutes. This is the time for the public to address the city council on any items on the special meeting agenda. The mayor will recognize that when you come to the microphone. Please state your name and the place of the residence for the record. While members of the public are encouraged to participate, it is unlawful to disturb or delay the council meeting with personal or slanderous remarks. The City Council is prohibited by state law from the taking action or discussing item not included on the printed agenda. Please direct your questions and comments to the City Council. Is there any public members wish to talk? Okay, it looks like we don't have anybody wish to talk. And then we're going to go to the agenda, discussion and the potential action items. Number 1, CSAC Access Insurance Authority Programs. A, Access Workers' Compensation Program. B, General Liability Programs. C, Property Programs. I believe we have some presentation.
Yes, good afternoon, Honorable Council and members of the audience. We have Lillian Van Vilt with our broker from Alliant Insurance Services here to give you a presentation on the insurance program.
Good afternoon, everyone. So I'll start off with a few qualifiers. One is that I was born in South America, so I speak very quickly. So I'm going to ask that if you want me to slow down, just put your hand up and I will slow down. It's just the nature of who I am. I am here on behalf of Alliant Insurance Services, and we are the selected broker for the CSAC Access Insurance Authority. Sort of a little outline of what I'm going to be doing this afternoon is I will be talking about membership in the CSAC Access Insurance Authority and the quotes that we were able to get from the program. Also, a little bit about your program and overviews of your losses to explain sort of the pricing and how we got to where we are, and a bit about the process that we've gone through over the last, now, 5 months, as we've been working through options for the city. Starting with a little bit about Alliant Insurance Services and the reason that we're here before you. The CSAC Access Insurance Authority is a JPA of JPAs, and so they're a large county pool that in 2001, expanded their program out to include public agencies within the state of California. They're effectively the largest property and casualty joint powers authority in the country, and they're by far the largest in the state of California. And a little bit further down, we'll talk a little bit about the organization and how they function. But one of the things that's unique about them is that we, Alliant Insurance Services, are their exclusive broker to help place insurance for them, both on the excess layers dealing with underwriters, and also in the primary layer dealing directly with insureds that may come into the program. So effectively, we're the marketing arm of the EIA, which is why I'm here representing the EIA programs. A little bit about Alliant. We were formed in 1925 in San Diego. Currently now, we are the 11th largest insurance agency in the United States. We just came 11th largest, but that says 12th, but we just moved up. We have over 2,100 employees in various cities and countries, cities and states in the United States. We are a specialty broker, and what makes us a little different is that we focus on different types of operations. And so the Newport Beach office, which is where I work, is actually focused solely on public agencies. And in that capacity, we work with 56 of the 58 counties in the state where we're the broker, and either through the EIA or directly. And we work with in some capacity, shape, or form, about 70% of the cities in the state, either doing reinsurance of programs. For instance, we're the property broker for CJPIA, or directly, I'm the broker for the city of El Monte. So it can be in any capacity or relationship. And the city of El Monte, for example, purchases insurance from the EIA. I have other cities, Southgate, that purchase in the open marketplace. But in some capacity, shape, or form, Alliant works with quite a few public agencies, and we're considered public agency specialists. Next. So what I'm going to do is explain a little bit about how to build out a workers' compensation rate. And the process that we went through when we started working out, we wanted to match up what you currently have. And what you currently have is a guaranteed cost program, first dollar, meaning that you write a check to your insurance company, and then your insurance company takes the claims and then they manage them. The relationship is called the deductible structure, meaning that, and think about your auto liability policy or State Farm or whatever. When you buy insurance, you go and you say, okay, I want to buy insurance from you, and they say, okay, your deductible is going to be $1,000. And then you have a claim, they deduct $1,000 from your amount, but they manage everything. They manage the claim process, they manage every aspect of it. You go to their auto shop, repair. So that's a deductible structure, and that's what you've been in place. That's what you've had in place for both your liability and your workers' compensation and your property programs. You have a loss, you contact your JPA, they handle it, and if you have a deductible, they take that out of the final settlement. We're going to be talking about a self-insured retention. And the reason for that is when you went before the committees, and the EIA is made up of different committees, and there's a process that we have to go through. So we have to actually go to 5 committees to be approved for your membership in each of the programs. And you have the option within the EIA of buying just one. So you could have gone and said, we only want to buy workers' comp from you, or we only want to buy liability or property. You can do that. So each committee had to review you. Each committee had to approve you. The primary general liability committee and the primary workers' comp committee didn't feel comfortable with the risk, didn't have enough time, and they passed it on and said we prefer to have them take on some type of retention, meaning that you all now are going to be self-insuring your risk. The difference between a deductible, as I mentioned earlier, you go to the person, they pay the claim, and they deduct out whatever your dollar amount is, and your auto policy is probably $1,000. In a self-insured program, you manage the claim. And then once you hit whatever your self-insured retention is, then you pass the claim on to the insurance company. So the difference is in a deductible structure, the pool would be in control. In a self-insured structure, you are managing the claims, you're managing the program. So now you're hiring a third-party administrator, or you're doing it yourself, and then when you get to a certain point, you buy excess insurance. So you kind of stop, you limit your exposure, but you do have the responsibility of managing the claims. Any questions?
It's like a bumper, but pretty much same thing, same way we're health.
It's usually, yeah.
The city's health insurance is the same way. First
Exactly.
$75,000 paid by the
Exactly.
city. Anything after that goes to the insurance.
And I'll have a visual in a minute, but I just want to make sure everyone understands the difference, because there's a difference. You're changing your philosophy, you're changing your structure, you're changing your funding, and I'll be able to help you understand the benefits and the risk in doing that.
Now with that said, the JPIA, 2012, we were paying somewhere around $1.5 million. And within the last 3 years, I mean, it more than doubled. It went up to $3.5 million. And so, I guess when that happens, it's because of those claims that's pretty much doubling, correct?
Correct.
Okay, all right, thank you.
And I'll explain to you what that is, and I actually did a summary of your claims to show you on the workers' comp side, which is there are two cost drivers in your program, your workers' comp and then your liability claims. And so I did a graphic, did some numbers for you to show you how that works. We're going to build out your rate now. And I'm a nerd. I know I don't look like a nerd, but I'm a nerd. So econ major from UCLA, so you're going to see a lot of numbers flying around. Please just stop me if you want, and I can explain them. But when you have a workers' comp program or any program where you're self-insured, there are actually going to be layers in your program. So the first component is going to be what's called claim liabilities. The next component is going to be your administration, meaning someone's managing the claims. The next component is going to be the excess insurance, that would be me. And then you're going to have your administration. You have to run the program, because remember now, you're self-insured, so you're running your own program. And then lastly, any good program has to have some loss prevention. So what I will do is I'm going to break through every one of these sections and tell you what they mean. So next slide. So your claim liabilities. You have an injured worker. The injured worker has to go, and they're entitled to medical treatment, they're entitled to temporary disability, they're entitled to all these different things. And you as an organization have to fund your claims. So what you do is you say, well, we have no way of knowing. You just said, last year we paid over $1 million in insurance. We have no way of knowing what kind of claims we're going to have next year. How do we know that? So what you do is you hire an actuary. In this case, you all hired an independent actuary. You use Big Morris Services. And you sent them all of your loss data and all of your payroll history. And you said, here's all the claims we've had from inception, and here are our payroll histories. And we want you to tell us what you see and what you project our claims to be based on probability, based on the industry and other cities in the state, based on the trends the state of California has for workers' compensation. And we're asking you to estimate how much we're going to spend in our claim liabilities. And we want you to stop that. We only want the number from 0 to 250, 350, 5. So we have different retentions in case we choose another retention. And what your actuary did is he went in and he created claim liability exposures for you at different retentions. So when you're building out your rate, the first and the biggest chunk of the money is going to be on your claim liabilities. First one, next slide. Then you say, like you do in your health insurance program, well, we don't want to pay more than a certain amount. We can't just take any claim. It can't be $1 million claim or a $5 million claim. We have to have some limit. So we're going to limit that liability, and we're going to buy insurance beyond that. So once the claim hits a dollar amount, in this case, we're actually proposing $125,000. Once it hits $125,000, the excess insurance company steps in and they take the claim and they manage it. Note to self, font must be white next time. The next list is going to be administrative costs. So you are managing this program. You're hiring a third-party administrator. You have responsibilities to pay with the state of California. You have certain fees you have to pay because now you are self-insured, and you have to be permissibly self-insured. Only public agencies in California can be self-insured. You just can't, anyone just can't say, hey, I'm going to handle my own workers' comp. And the process is you go through a process of applying to the state, to the Department of Self-Insurance Plans. They issue a certificate to you, and I think that's on the agenda later on. And once that happens, you then annually have to pay fees to the state of California. So you have to put in the cost for your administration. And then lastly, any good program has to have some loss control. You have to do things to stop claims from happening. You must have some training. There are some things that are required by law. CalOSHA, for instance, says that you must train employees if they're exposed to blood. You must train employees for sexual harassment and awareness if they're supervisors. There are certain things that by law you must do, and so you've got to put those things into your program, and you should fund for them. So you have loss prevention. Next slide. And now you've built out your program. It's going to now build out. So you've got your claim liabilities. You have your, just keep hitting it. This is for my dramatic effect. So now, a definition of claim liabilities. It's actuarial science. And what's really important about this is to understand is that, remember, you're self-insuring your risk. So now these are your claims. So someone gets injured, Johnny gets injured or Lillian gets injured, and you now have to pay for the claims and you fund for them. So what you do is you create a fund, and you're keeping the dollars. You're no longer paying it out to an insurance company, or in this case, to your JPA. These dollars remain with you. Now, remember earlier on I said you hired an actuary, and you said, can you tell us how much we're going to spend? So the actuary says, I think you're going to spend $1 million. And then you said, well, how confident are you in that number? And the actuary says, well, the law of probabilities. So if I flip a coin 100 times, 50% of the time it's going to be, say it with me, heads. And 50% of the time it's going to be tails. So the more you flip the coin, the more it's going to come back to that 50%, 50-50. That's the law of probability, law of averages. So you tell the actuary, you said, well, how confident are you with the number? And he says, well, 50-50. I am confident 50% of the time. But remember, the law of averages means that over time, it's going to be this 50%. So 50% is, in actuarial terminology, it's expected. It is what, at the end of this exercise, when we go out 7 years or 10 years from now and we look back, you're going to spend about $1 million. But maybe one year the actuary flips and it's heads and it's 300,000. Another year it's tails and it's 800,000. Another year it's heads and it's 400,000. Another year it's tails and it's 600,000. So you're going to have this fluctuation, but over time it's going to be 50%, or in his case, $1 million. So the actuary, you say, well, we don't necessarily like that fluctuation. We don't like the fact that you could be wrong half the time, even though we know eventually it's going to come into this number. So we want you to be more confident. And the actuary says, okay, well, if I'm more confident, the number now goes from $1 million to $1.2 million. And that's my 70% confidence number. So 7 out of 10 years, I am now going to be, you're going to have proper funding. And more than likely, that extra $2,200,000 will, over time, it'll build up and you'll have a reserve. It's important that you guys understand this concept because later on I'm going to show you numbers with 50 and 70. 50 is where it's going to come in, it's expected. 70% is giving you more cushion and comfort, and also it helps you to build your coffers. Your excess insurance rates. You are purchasing from a pool, next slide. Next slide. You're going to purchase from a pool your excess insurance, and you're also now going to have, so we've now said, okay, once a claim hits a certain amount, it's gone. The next is going to be your administration. Now, this program says that we want you to hire someone to administer your claims. You do have the ability on occasion to manage your own claims, but because you've never done that before, the pool didn't want to give, they wanted you to have hire an independent outside agency. So you're going to hire a third-party administrator. And basically what that third-party administrator is going to do is they're going to act as though they're you. You're going to create a trust account. All the dollars from the claim liabilities are going to be in your trust account. You hire a third-party administrator, and contractually you tell them you are now going to be the city of Calexico. When someone calls and they deal with you for all of our claims, they're going to deal with you for all of our issues. Currently, you work with York Risk Services, and that's who your third-party administrator is. That's who CJPIA uses. And we're proposing or suggesting that you continue that relationship. So you're not going to have any change, but it's just now the relationship is going to be directly with you in York, not through your current JPA. You also, as I mentioned earlier, have costs. You have to hire an actuary. That costs money. You have to now do audits. So you're going to hire an auditor to come in, and that costs money. You also have now, you're part of the Department of Self-Insurance Plans, and you have to pay fees to the state of California. That costs money. There's another program called the California Insurance Guarantee Association. And that says, it stands for CIGA, and that is an agency within the state of California that if, for some reason, your carrier becomes insolvent, then CIGA will step in and pay your claims. So there's some guarantee that if something happens with your carriers, then the claims will be paid. And this is something that, by the way, the structure we're talking about is the exact structure that CJPA follows. Now you're just doing it yourselves. This is not anything that's new. It's just now it's directly, you guys are, all the contracts are directly with the city. And lastly, you have what's called, well, I mentioned it before, your examiner fees, which are going to be the person that you guys handle. So those are your administrative costs. Next column, next slide. Loss prevention. The EIA, their underwriting committee was very concerned about the fact that you had a process improvement plan. They reviewed that. They felt you did a really good job in getting all of your things done. But they wanted to ensure that the focus on loss control continued. They're very focused on their membership and loss prevention programs, and later on I'll talk about what those are and what they'll be offering you, but they wanted to make sure you all had something in place. One of the requirements of membership in this program is by January 31st, you must have a loss prevention program or contract in place with a consultant. They want to have someone in place to help you manage through this process, manage through your claims. They will be, and they have offered to assist you with that process. They've offered to assist you with finding people and agencies, but they do want you to have a loss control program. So now, your loss prevention services, what are those? Well, as I mentioned earlier, you have to have a risk consultant, so they want to have someone in place. They're not requiring that you hire a risk manager, but the suggestion is that the agency work towards that and work towards hiring someone permanently. It's cheaper, it's a better cost because you're going to spend a lot of money for a consultant.
I
Sure.
think I misunderstood. York is already our risk management with
No.
with JPIE, correct?
So York is not your risk manager. York is your third-party administrator. And all they're doing
They
is,
don't do risk management?
no.
Okay.
All they do for you is manage your claims. So if someone comes to you, in the case of workers' compensation, they say, I've hurt myself. They contact York, and York manages the claim, ensures they get the proper services, ensure that they get medical treatment. They negotiate the settlement on your behalf, and they do all of that, and they will do all of that with your dollars from a trust account. But when I say risk management, I'm talking about things up there where it's going to be employee training and health and wellness. It's going to be ensuring that all of your employees have a safe work environment. It's more of the risk management and not the claims administration.
Okay.
Good question. That's a good point of clarification. Your services should be loss-directed, and what a loss-directed program means is that when I'm hurt, someone should be tallying the losses that we've had and seeing where claims are happening, what department they're in, ensuring the department has proper training, ensuring that, okay, well, we noticed in this one department there's lots of slip, trips, and falls. Let's see if we should get them better protective equipment. Maybe we should do some more training. Someone should, and that's really there, and it's designed to reduce claims. A loss-directed training tends to be based on losses and our trends, and also what's going on in the industry. Like right now, there's a big issue towards cyber liability, so you want to make sure that your IT department has proper protocols in place, those types of things. That would all be risk management. Risk management is doing things that are designed to prevent a loss from happening or to mitigate the loss once it has happened. You also are by law required to do OSHA training. Cal-OSHA is the Occupational Safety Health Agency. Whew. Almost forgot that one. So you have Cal-OSHA training. There are things that you have to do. I mentioned earlier, if someone's exposed to blood, the custodians have to be trained in Cal-OSHA for bloodborne pathogens. If you're maintenance and operations, if they're out mowing the lawns and the sound is too high, they have to have protective equipment for their hearing. If you have people that might be exposed, if your bus yards or you have gasoline, they have to have eye wash stations in case there's a spill. So you have to have these things that are required by law, and you have to have a process in place to do that. Next slide. So now that very small print there are your dollars. Thank you, because I can't see it. Remember earlier I was breaking out the rates and all the costs? So let's go from top to bottom, and I'll explain to you what the options were and what they've been presented to you from the CSAC program. So the current claim payroll, and in workers' compensation, everything is based on payroll. It's done to have, say, for instance, comparing the city of Calexico with the city of LA, with the city of Sacramento, with the city of Poway. You want to have one thing that's consistent, and payroll across the board is always going to be consistent. You can be used to, does everyone have this? Yes. Okay, sorry. It says excess workers' comp across the top because there's two of them. So we start off with that. So AM Best Rating. AM Best Rating is an independent agency that rates insurance companies. You want to have an AM Best Rating or a company that has A-7 or better. And all the proposals that we've put forth and all the carriers that we work with are A-7 or better. It's very important that you do that because you don't want to be with a carrier that will be insolvent and not there to pay your claims. And the reason you have various is because the EIA program and the CJPA program, actually, they work with several insurance companies. They don't just work with one carrier. They usually layer their programs by buying insurance depending on the exposure. The next one is confidence level. So how many of you remember me talking about confidence level? And remember I said 50% is expected? So 50% of where your losses will come in, based on actuarial projections, based on a city of your size, based on how your claims have panned out. So if you were being aggressive in your funding, you could say, we know that we're going to be at 50% confidence level. And you could fund at a 50% confidence level, and you would be funding properly because that's where your claims are going to come in. If you want to be more conservative, you can say, well, we want to have more confidence in our number, and we want to build up our coffers to allow us to have a fallback in case we have a bad year, or maybe the first year out isn't as great as we thought it was going to be, and so we have some money built into our fund. So the dollar amounts, you'll see one is 50%, that's in blue, that's expected, and then I put a 70% next to it to give you the comparison between funding at what the actuary says is going to come in and funding at where to give yourself some extra cushion. I'm sorry, I'm not looking at you guys, but you know I'm there, right? The next one is your self-insured retention. For the workers' compensation program, we got options for you at 125,000 retention, 250,000 retention, and 350,000 retention. So as you're going across, you'll see from left to right, the numbers go from 0, which is where you are now. You have no retention. It's a first dollar program, and now you're taking on some retention. Statutory. That means the limit that you're going to have from your insurance company. And statutory means no limit. Essentially, it means no limit, because what it's saying is that whatever the statute says you have to pay the injured worker, that is what our policy is going to pay. We can't say we're not going to pay, we're only going to pay $1 million. For example, it's a good example, there was just a big loss in San Bernardino. It's county employees and city employees, city of San Bernardino police officers were shot. That's one claim, because a workers' comp is a per occurrence loss, and so all of those individuals being injured is one claim. So the carrier can't say, oh, it's going to be $1 million per injured worker. They have to pay all the claims, and whatever the cost is going to be, that's what the cost will be. And so we're not suggesting you're going to change that. The excess premium, your current premium now is on the slide. You're paying $1,503,010. That's for the 15-16 policy year. So in essence, you're paying half of that because you're going to be canceling your policy. And then when I said excess premium for the EIA programs, you're $354,256. That's the cost of insurance from 125 to statutory. 125 to statutory. And then if you go over, you'll see 250. It's from 250 to statutory. And over once more, 350 to statutory. Now you're going to say, well, wow, we were paying $1.5 million last year, and now the insurance is going to cost $350,000. That's a bargain. Well, it is, except you also have to fund your claim liabilities. So the actuary says for your claim liabilities, they believe, based on your losses and your loss history, at expected, you're going to spend 1.140, and at a 70% confidence level, you're going to spend 1.338. So now you look at your claims, and I actually have a slide. I don't know how much time I have, but I do have a slide up that can show you your losses and your loss trends, if you guys want to see that, or you want me to keep going?
Yes.
I would like to see it, yeah.
Okay.
We don't have any, I don't believe we have any policy information from our last policy. Did you provide that anywhere? I'm sorry, I didn't get this till today, so I haven't reviewed it at all.
And I apologize if you didn't get it today, because they just got it about an hour ago.
No, the whole package, I just got this today. I should have had it yesterday, and I didn't.
Well, my presentation and all the presentations, they literally got them as we were driving, as I was driving here, because the carrier just released the liability code at 12:10.
Yeah, I got mine about an hour ago too, so.
That's my fault.
So we don't have any information on what the terms were, what we had before? Can we actually have that right now? I tried to download that to see if I could find that with the terms of what we had before, so we can kind of compare. I believe you can actually download that unless you already have that available, because I think it's important today that we look at what we had. You're going to give us a piece of it,
Well,
right?
actually, if you look at the first column, it's what you, in terms of what you have, the first column is what you have, what you pay. So it says current.
I actually wanted to see the whole thing of what we had before, and because we're breaking things down now, aren't we? I mean, this, for example, the workers' comp is kind of being handled very differently with the so it's important, I guess, to have had that today, and I didn't have the opportunity to print it.
I understand. I want to make sure you guys understand. So I want to answer your question in terms of comparing the programs. The coverage that you have now with CJPIA is a first dollar program. You are buying insurance to statutory coverage, and you're paying 1.503010 for your insurance premiums.
I'm sorry, I didn't hear you correctly.
Oh, I'm sorry. Speaking to the wrong people, sorry. The coverage that you have now is with CJPIA. It is, let's not go there yet, because that'll confuse everyone. The coverage that you have now is with CJPIA. You are, they hire York Risk Services as the third-party administrator, and they have statutory coverage. Workers' compensation insurance, the limits and the structure are actually defined by the state of California, so you don't have an option in terms of what limits or terms or anything like that, because the state of California says what you can and cannot do. There's a labor code. So labor code defines and outlines how the coverage is going to be. So what you're doing now is, one, before in CJPA, you were paying a check directly to them, and then they were managing the program. In this structure, you were going to be the ones managing the contracts, but in terms of the coverages and the limits and the structure, it's legal, it's defined by law.
The state
So-
controls
The state
what
controls the
insurance you have to have, pretty
Correct.
much.
Correct. So I just want to make sure I point that out. That's different in
So
liability.
in other words, it's illegal for us to go less than what CalJPA had us in the first place.
It's illegal
We
for you
can't-
not
we
to
can't
have
go-
workers' compensation coverage. Now, you could not buy statutory coverage, you could buy a $100 million limit. But why would you if someone's offering you statutory coverage? Why would you limit yourselves? And as a general rule, the CSAC program doesn't limit, so they offer statutory coverage. But now liability will be different. But in terms of workers' comp, there is the program structure and the limits and the coverages are all, it's the state requirements. So now your program, if you want to look at your losses, this is an example, this is actually a breakdown of your claims as of June 30th for the last 10 years. So the first column, you'll see it goes from 2005-06, and you have a total paid column, and then you'll have a reserve column. So the total paid is how much you spent.
Is that in here?
I don't know. I don't think so.
Could we have a copy of that?
Total paid is how much you spent, and the total reserve is what the TPA, which is in this case York, thinks you're going to spend on your claims going forward. Your total incurred is $709,443 for the first year, and the last year, 14-15, you're at $827,607. And you'll see some years in there you're at $449, other years you're at $1,000,003. Lots of movement, lots of variation in your program. Your claim count, however, stays pretty consistent, around 50 claims. 54, 50, 54, 54, 55. So those are the, your injured workers are having losses. You have 176 employees, and you're running about 54 claims. Next slide. What we do then,
Can I ask you, is that,
sure,
that seems to be, that's pretty high for 170 employees?
yeah, it's a little high,
That's 30% of the,
yeah.
wow.
It helps to explain your costs when you're talking about your costs. So next slide. Remember the actuary we hired a little while ago? What that actuary does, you'll see the first column says development factor. He actually breaks out your claims by year and says, I think this year you're going to spend this amount, I think this year you're going to spend this amount, and they break the claims out by program year. So we've taken that actuarial development factor, we've overlaid it against the reserves that the TPA already has up on the file, and we give you a new number called developed total incurred. If I were to look out 10 years from now, and I look back on your claims, the developed total incurred is where your claims are going to actually ultimately end up, based on predictions in the industry, based on what we see, and this is what the underwriters are looking at when they're looking at your program. So, you develop total incurred. As you can see now, the numbers are markedly different. Your total incurred for last year goes from $827,000 to $1.9 million, which is a little disturbing, and that's one of the reasons why you're seeing kind of the quotes and why the recommendation that you guys go self-insured versus taking on a first dollar program. However, in the 13-14 year, you're at $594, which is a really, that's a good program and it's a good cost. And so you kind of get an idea of how your program is moving. And one of the things you'll see is that it's kind of bouncing up and down, bouncing up and down. And that's part of what gave the underwriters some pause and why they wanted you to have some retention and wanted you to take some ownership of your program. Next slide. The difference between the red is where the actuary says your claims are going to end up. The blue is where the claims are now. Actuaries are they're notoriously very conservative because they don't want to be wrong. You ask them to give you an estimate. But the most current year, they don't know what they don't know because people haven't had surgeries yet. The claims haven't been litigated yet. There's lots of things that haven't happened in the claim. So the most recent year tends to be the most volatile year. However, it's also the year where you have the most opportunity to lower your costs because the things haven't happened yet. The person hasn't, you can bring them back to work in a return to work program. You can do things to help yourselves and get the claims down. You can also, you can have a more robust risk management program. So there's an opportunity for you to be able to lower your cost. I mentioned earlier, a little bit of a nerd, so this is just more graphics and breaking out your numbers, telling you where your claims are happening. And as you can see, you've got a lot of claims happening in your $0 to $5,000, so a lot of small injuries, people aren't off for very long. And in your instance, it may be a little bit of death by 1,000 nicks. You have a lot of claims and you have a lot of costs, but the bulk of them are in small injuries and small claims, which is good because that tells you that you're able to, they're not big injuries. These are things that people can come back to work, you can manage the program. So we can go back to the PowerPoint now. But I wanted you to have an idea of how the actuaries were seeing your program and and where they were evaluating your costs. So those numbers there are what drive your claim liabilities. Now, we are to our numbers, claim our losses, and we're at 1140 for 50%, and we're at 1138 for 70%. They also gave you an option at 250, which is a 1492, and at a 70% confidence is 1552. The last 350 SIR, that number still has to be approved by the underwriters because the committee only has permission to go twice their SIR. So they went from 125 to 250. If you guys choose the 350, we'd have to go back and get permission, but that's the estimate of what the number would be, 1.6 million to 1.682. I mentioned earlier state fees, and so you have to go to the state of California and pay certain fees. That's estimated to be about $25,000. And lastly, as I mentioned earlier, you are required to have a risk management program in place. What I did was I split the cost of what I think it would cost you for risk management between both programs and my estimates. I estimated $140,000, and I put $70,000 as a number here and $70,000 in the liability program to help you with the funding,
So here you actually included all the things that we need, correct?
based on what I believe that you should spend. So that gives you a total premium. So you're comparing last year's premium, or the current year, 1503010, and at a 125 SIR, at a 50% confidence level, it's 1519016, which is about a 1% difference. I was pretty happy with that, but then again, I'm a nerd. If you went to a 70% confidence level, where you took on more, you said, okay, we're not comfortable funding at expected, we're more comfortable funding at the 70% confidence level. We know we're going to have some extra money, but then we'll just, as the years go by, you'll build up your coffers, and then you'll be able to, fund at 50% because you'll have the confidence of the money in the bank. The total numbers given you there are the total cost for the program. What you have to pay to the EIA is the excess insurance premium. So the claim liabilities will stay here in your fund, and you will manage them. You'll pay your excess insurance premium. There's some dollars built in to hire loss control consulting, and there's money built in for your state fees. And that is the workers' comp program. Any questions?
I have a question.
Oh, yeah, please, please.
So when I contacted Alliant, and they contacted back in, was it like July or August? So a while back, and I sent you all the loss runs and all that information so that, because we needed a plan B.
Mm-hmm.
And obviously, I want to thank you for being here and working with the city of Calexico. One of the things that going through all the loss runs and everything, which was a lot of information, I noticed that we pay JPIA, I think in the last 3 years, somewhere around $6 million within the which was 2012, 13, 14 now. But when I asked them how much they actually paid out, it was only like $2 million. So would this mean that now Calexico could have the possibility of, if our losses were less, that we could save money?
Correct.
So we'll be able to, we could in the future have, JPIA, they just kind of put that back in their account, right? And we never
Yeah.
see that. Versus now, if
You
we have
actually would see it, because as a part of a JPA, when you join a JPA, what you're doing is the concept of JPAs are joint power authorities.
Yeah.
So similar
It's a
agencies
pool.
come together, and you pool your losses and your risk. And you're as good as your worst member. And you ride together and you fall together. And so in a JPA, if the program does well, and everyone does well in the program, dollars come back to you in the form of rebate. If the program doesn't do well, let's say you claim liabilities, you funded at 50%, and then it's coming in at 60%. So now you look back and you say, you know what, we didn't collect enough money, we need to put some more money in the bank, which could happen to you. If that happens, then the JPA does what's called an assessment. And part of the reason that your costs were so much in the last couple of years is because there was some retrospective premiums that are being paid as well to the program for prior years where they weren't necessarily as good as they had hoped. So, and that applies too with CSAC. Pools are all the same across the board. If you do well, you get money back. If you don't do well, the program will The difference is now it's only you. So if you do well, you don't have to worry about, oh, maybe the city next door didn't do well, so we're going to have to,
Well, yeah,
rise
that-
and fall.
Yeah, because that's kind of the way, when I started looking at other cities in the county that also belong to JPIA, their coverages weren't going up nearly as close as ours
Yeah,
was. I
but you
mean,
look
ours
at your,
was just
but look at your
skyrocketing.
loss trends, right? And you have to look at, from the standpoint of an underwriter, which is what I look, when I look at your program, I'm looking at it from an underwriting perspective, you've got a lot of volatility. And so when a program is being evaluated from an underwriting perspective, you don't want to be the one in the year where all of a sudden it goes, $1.9 million. So if you're paying $1.5 million and the actuaries say now they think it's going to come out at $1.9 million, JPIA theoretically could lose money this year in the program. So when you're looking at the program, you can't look at what you spent thus far. Look at where they think your claims are going to ultimately end up, which is the slides earlier. And trending out, you're doing a lot of this.
But
But
my,
your point is, I understand what you're saying. If you guys do well, you could keep a lot of money in your program.
well, I believe that, and this is kind of why that threw me off, because if you belong to a pool, then shouldn't your cost always be, I mean, it shouldn't go up that much because everyone's sharing, the good with the bad. But it seemed like with JPIA, it was, they weren't increasing everybody, but just Calexico.
That's not, well, that's the problem with that. That's called an adverse selection. So think about it. If I know I belong to the pool, and no matter what I do, my rates will never change, and you're next door, and you're doing everything right, and you're keeping your costs down, is it fair for both of us to have the same rate every time and never have any difference? No. So what pools do is they experience modify. They take your losses, and in the case of CSAC, they actually do an actuarial study. But take your losses, and they say, okay, well, this client here, this member, we think the average is going to be 1. And this member is performing at 1.35. So that means they're 35% worse than the pool or the average. Or they're at 0.68, which means they're 32% better than the average. I'm sorry, 42%, 32%. So in that case, if you're the better member, you're going to get a 42% reduction, 32% reduction. If you're the member that's at 35%, you're going to pay 35% more. There's going to be an average rate, and then people are going to have rates all up and down the spectrum based on how their claims are performing. Because if you don't do that, your pool will continue to rise because no one has an incentive to keep their claims down. So you reward the members that are doing well and keeping your costs down, and you charge the members, the ones that are raising the cost. And you get an average.
So it's a pool, but it's not really a pool.
It is a pool. It's a pool, and where you're buying, but the idea behind it is
It's a pool as long as you behave. But once you start, then you're no longer in the pool.
And it's the same thing with insurance. You think about it, and I'll give you an example where you might be more appreciative, and I go back to auto insurance or your homeowner's insurance. You have an auto insurance policy, and you get the good driver discount, you get the family discount, multiple cars, you get the college graduate discount, the alumni association, but have a claim. And do you get a discount? No, you lose your discount, and then you get a charge, and they raise your rates. And if you have another claim, you get another charge, and they raise your rates. And you have 3 or 4, and they'll tell you you have to raise your retention. You can no longer have $100,000. So it's the same concept.
So in your expert opinion, the rates that the losses the city has had, you say the last 10 years are pretty much very close. Every year is almost the same.
If you look at the loss trend, you're different. Look, you changed. That's okay. The loss trends, which it's another PowerPoint.
It's another click on the
You
bottom.
look at the loss trends, you'll see. Remember, I showed you the red and the green bar.
Yeah.
Your program is going kind of like this. And
So-
is that consistent with the other members? You'd have to ask CJKA. You see what your X mod is in the pool.
No, I actually did. I did ask them compared to other cities, and I think they said that we were like 4 or 5 times higher than other cities. So, I mean, I think that, and it's been like that for many years, I guess. It's very important that we get somebody that helps us with the risk management side and getting these things on track.
Yeah, in comparison to the EIA program, I think you guys are, I want to say you were 22% higher. So you're still high. So there's an opportunity even within the excess layer for your costs to come down as you improve your program.
Excuse me, Lillian, are we still talking just workers' comp right now?
Yes, yes.
Did you, I'm sorry I'm late. I'm sorry I was late.
Oh, no, no, no,
Lillian.
that's fine.
Today's my son's birthday, and we had
Oh, happy
he works at my office, and we had some lunch today.
Happy birthday.
Thank you. So, did I miss the explanation about liability?
No, 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 I haven't gotten there yet.
Okay, good. So we're still on workers' comp?
Still workers' comp.
Okay. So may I ask you then,
Please.
we just discussed right now the perfect world where everything's great and everything's good, but this is Calexico, so let's see. You gave us an example right now about Riverside, that Riverside did have an issue where, I believe you said that they were also self-insured? Was that what you were saying? With the incident that happened in
Yes.
workers' comp related, there's going to be quite a bit of claims, right? Now, is Riverside insured, self-insured? Is that what you said? Okay. So in that type of an event that things do happen, what would be the effects in that regard when you have something like that, where you do have over and above the normal, the 50 claims a year average that we're having? What if we don't have a good year? What effect does that do to our whole program points? For example, our rating, our price, all that kind of stuff. Give us that other side of it.
Sure. Should you have a couple things? One is, right now the actuaries believe you're going to run at about $1.9 million. Now remember, you're capping off every claim at $125,000. So you've got two programs running simultaneously. One is your self-insured program, your claim liabilities. So that's going to be what in this case, your actuary says you need to fund. So let's say you have a really horrible year and you have a terrorist attack or something like that. From a claim liability standpoint, that's one claim. That's 125. It's not going to really have that much of an impact on your program because as soon as you hit 125, it's passed off to the excess carrier. So an example like that wouldn't really move the needle in your program. What would move the needle in your program is you went from having 50 claims a year to having 100 claims a year, and all those claims were less than 125. So they all stayed within your pool layer. If you look at your program, historically, you've been around 50 claims over the last 10 years, so I don't see a lot of movement, and even if you did that, you'd have to have a lot of claims, above 50 claims, that were below 125, but still big enough that it would make a big difference. Because right now, you're funding at about, we're recommending between $1.1 million and $1.3 million for those claim liabilities.
Okay.
So if we had a mass shooting, it would cap at 125, and even if it was $10 million, we'd
God
be
forbid,
okay.
but yes. In the case of a catastrophic loss, and then this is important too, for definition of insurance, you're buying per occurrence coverage.
Yeah.
And that's what you have now, that's what you're buying going forward. And everything I'm talking about is going to be per occurrence. And a per occurrence coverage says that if I have a claim, the claim is deemed, it's the occurrence, not you got shot, you got shot, you got shot, you got shot. It's that everyone that gets shot today by the same person is considered one claim.
Workers' comp-wise.
Everything. It's the same thing in liability. It's actually the same thing in property. If there's a storm that comes through and the storm damages this building, and that building, it's all one claim. Per occurrence. And per occurrence coverage is, by definition, the best coverage you can get in both of your pools. And most of the pools in California actually have per occurrence coverage. Where your concern should be, and I recognize that you have concerns, where your concern should be is if you don't have, and this is why they want you to have risk management, if you all of a sudden start having all these claims, and you go from 50 to 100, that would be concerning, and that's where you have the risk of not having proper funding. If
Because
you don't have proper funding, what would happen is next year, you need to fund more money.
But historically, for the last 10 years, we've been about, we
Yeah,
stayed.
I showed you that you're running about 50 claims.
We stayed,
historically.
okay.
Yeah.
So as far as getting the approval from the state of California for the self-insured status, how long does that take?
We started the process just in case.
I'm sorry, you started the process
You
just
started
in
the
case?
process just in case.
Just in
What you need
case?
is your resolution, which has to pass before the end of the year.
Or just in case it was approved today, you mean?
Yeah.
Okay.
Because if you
But
didn't-
how long does it take to actually have the approval from the state of California?
Once you have your resolution, they should be able to approve it within a week. So the resolution's on the agenda for today, I believe. So you'll have it by next week.
Okay, before the 1st of January?
Correct, yes. And we called the state just to make sure as well.
So you give me a little more clarifications for the, let's say you say the occurrence, for example, Mr. Mandy Leal, he got cut the paper cuts.
Is that a threat, sir?
And then Mr. Castro got a little bit tripping the leg. So there are two occurrences.
We're not insured.
Yeah, two occurrences,
talking
because
about the
they're two,
employee.
those are two occurrences.
Yeah, two occurrences.
Two
So
occurrences.
each occurrence is $125,000.
Correct. And what and the way your program is, the way your actuary looked at your program is they saw your performance over the last 10 years. Well, actually, they had more than 10 years. I just put 10 years up. But they had your entire program from inception. And they looked at your program trends and said, based on the program trends, they're going to spend an expected 1.1. If I put more confidence in the number, 1.3.
Do you
And they did
know,
it at each retention.
are you aware if the state of California requires that a city have financial proven strength to be able to even take on a self-insured program?
Yes.
Okay, so usually what type of proof do they ask to be able to prove the financial strength?
Surprisingly, here's the thing about the state of California, and I'm on video, so I've got to be careful. If the state of California came in, and what you're going to get is going to get an audit exception on your audit. It's going to have an exception if you're not funded properly in your program. But the state's not going to come in and fine you for not having your claim liabilities. The reason that's not going to happen is, I'm sorry. Yeah, you're shaking your head, so what?
Yeah, can you start over?
Sure.
Yeah.
You're asking about
because
whether or not the
our-
state
our-
has to have.
Our city is not yet completed for 14-15 financials, nor have we been audited for 14-15. We are a bit undone yet.
Yeah.
We're not done, so is that a requirement that the city have the financials ready to go to be able to show the financial strength? Do you know?
No, they used the ones from last year when you
From-
were completed. They used the 13, 14.
In other words, she wants
A
to make
whole-
sure
a whole
we're
year and a
not
half ago?
insured.
Yeah, over a year and a half ago.
Okay.
While I recognize the concern that you're a public agency, the state also knows that you're not going to become, even if something happened and God forbid you became insolvent, there's still going to be a city of Calexico. You're not like the manufacturer down the street that if you go out of business, you're no longer around and they can't find you. You're still going to have the city of Calexico. You're going to be in some type of receivership, and then you're going to come out of it. So the state views public agencies a little differently than they view Joe's Auto Shop or another restaurant, something like that. It's a different, which is why you're allowed to be self-insured in the first place. If you are not a public agency, yes, you do have to show financial solvency. You have to put up what's called a letter of credit, and you have to have collateral. There's a huge process in place, but that only applies to non-public agencies. Public agency doesn't have to do that.
Thank you. So every time we occurred of the claim, we have to put $125,000 deposit on it?
No. You're going to put depending on how you vote and what you guys decide, and that's your choice, you're either going to put $1.1 million or you're going to put $1.3 million into a pot. And then that's what they're going to use to pay claims out of. Now, recognizing you're not going to spend $1.1 million this year. It's going to take you, in theory, about 7 years to spend that. Most claim development, if you look at your program and look at where the costs are, claims tend to start rounding off and they level off at about 7 years. The bulk of your costs happen within the first 2 to 3 years. But you're going to put 1.1 or $1.3 million in the bank, and that's going to cover all the claims that happen, whether it's the finger cut or if it's the hand being severed. Those are all going to be paid out of that claim from 0 to 125. Once it hits 125, it's passed over to the insurance company, and they handle it from there on to statutory coverage.
Thank you.
You're welcome.
Go ahead.
Any other questions?
So can you go next?
Yes, okay. The next one is your liability. Actually, I went fast. I gotta go back, please. Okay, this is your liability. I have that one too. This one I got at 12:10. So I apologize for the lateness of the hour, but we were trying to get them done. Same concept. In this case, what the carriers have done is they've said, we want you to have a $225,000 retention. That's the lowest they'll offer you. You must take on all claims from 0 to 125. Now, you think of liability, think of your general liability would be, and I'm going to do this because I'm visual, but it helps. General liability is going to be things like slip, trips, and falls. Things that happen to my person. Someone's walking in the city and they fall or hurt themselves, or, God forbid, you've got some type of physical injury to someone. It also has coverage for auto liability, as your police chief fleet.
Is there a reason why the GL was capped at 250,000? Is it 250 per
It's not
occurrence?
capped, that's going to be your claim liabilities. Remember
Correct.
that this.
So how do you guys figure that amount and not 125 or?
The underwriters looked at the losses, and they felt that at 250, they wouldn't see very many claims,
Okay.
basically. Most of your claims fell below that layer, so this became true excess.
True excess, okay.
That's why, so that's where the cap. Good question, by the way. So in this scenario, the difference is that you have a $250,000 retention, and then on the other end, in liability, there is no statutory coverage. Liability, you have a per occurrence loss, and you have a loss limit. Currently, that loss limit is $50 million. And you have two options that we put in before you. One is 25 million and one is 50 million. The reason I did that is because in the CSAC program, you can buy, you can choose what your limit is, whereas in CJPAA, everyone has one limit. So I gave you two options because you may want to lower your limit to save some money for the first year as you guys are moving forward, as you make decisions. Your excess premium this current year is 1167768. And at a 250 SIR, the proposal is $460,000 roughly. I think that number is actually going to come down a tad bit, but it's about $460,000. And if you were to buy limits up to 50 million, it would be 660,000. The carrier for the excess layer from 15x of 45, 15x of 35, there's one carrier all the way up there, and they hadn't given us permission when we came in the room at 12:10.
Has the city's GL claims ever gone over 25 million?
Oh, no.
No, okay.
No, not at all. I don't think you guys have anything over $1 million, actually. You had 5 that were close to $1 million, but you've never had anything over 25.
Not even a million?
Yeah, I think you've
Okay.
had 5 that are over $1 million, but they're like $1.1 million, $1.2 million. Yeah, no. $25 million is a pretty sizable program. Consider a JPA would carry $50 million for all of their members, so, you know. But you do have options, and so it's good to have some options and be able to have a discussion about where your limits are and if you want to stay where you are and stay consistent, that kind of thing, price structures. Now, back to the confidence level. Expected, 50%, or a buffer, 70%. The actuary also gave you numbers at 80, 90, so if you want to go and put more money in the pot, you can do that as well, but you have those options. Same thing here, you've got third-party administration fees, which we've got quotes for that. And then you have loss control. I did the same thing here. As mentioned, I did 140 and split it in half, so 70 here, 70 there. And then lastly, because everyone's asking the question about terrorism, which is appropriate to ask, this includes terrorism. That's a good question to ask, and so I put it in there just to see. There are no requirements in the state of California. You don't have to, unlike workers' compensation liability, you don't have any state requirement, and you don't have to do any DSIP fees.
Did we also have the terrorism with?
Workers' comp, yes.
Okay.
And workers' comp is kind of, you are required to get an injured worker back regardless of why the injury happened. So there's no, you can't say, oh, because it was terrorism, we can't cover it. Liability, you could do that, so they just make sure you know it's in there. So now your total premiums are 1167768. And if you do a 25 million limit at 50%, it's 988. If you do a 25 million at a 70%, 1083. If you do the 50 million, it's at a 50%, it's 1188. And if you do a 70 million, it's 1283. So this is a same concept, just a different structure. In this program, everything's the same. You'd have to have a third-party administrator. You'd have to report your claims once they hit your retention. But this program, your retention is now $250,000 per occurrence.
So if the council was to go with option 1, there would be about $179,000 savings compared to what we had in the past.
Recognizing that you are talking about funding your claim liabilities, so this is if your claim liabilities come in expected.
Okay.
Did you mean that the same thing that you said about workers' comp, that a third-party administrator would have a cost? It's a separate...
Actually, it's included.
It's included, yeah.
It's included in your actuarial projections for the workers' comp.
I thought you had explained on workers' comp when we went through everything that there's the need for to create a trust account, a third-party administrator with a cost, and then and then there's going to be a risk consultant with a cost, right?
Yes.
That's all
Okay, so
included.
you just said that it's very similar, then the same idea, right? For liability?
Yes,
Okay, so then in liability, then we'd have to pay for a separate third-party administrator?
yes. And that line is where you see TPA fees. You'll see where it says TPA fees, and it says 30,000.
Okay, those 30,000 is it?
Yeah.
This is
You
all
do not-
inclusive, everything's in here.
Yeah, you do not have, however, to pay for state fees, because unlike workers' compensation, liability, you do not have to pay the state of California. There's no Department of Self-Insurance plans overseeing workers' liability. So the number here includes the loss control, it includes the third-party administrator, and because there's no TPA, there's no DSIP, that's not on this one. But that's the difference, is the state fees.
On this chart here, you did not include the, I'm just wanting to make sure what we're looking at.
Yeah.
On this chart here, you did not state the TPA fees?
Because you see where the claim liabilities number says discounted losses and ALAE funding? Your actuary actually included the
Oh, it's in
TPA
there.
fees in that number.
It's in there, okay.
Yeah. And technically, it's in this number too, but I put it out because I wanted to, I was being extra conservative. I put it out in the liability because the concept, the change on liability, which we haven't gotten to yet, is the third-party administrator in workers' comp was York. And you're going to keep York if you guys choose to do so, because you have that relationship.
We would
Now-
keep them, but we would have to pay their fee separately.
Correct.
I
But
mean,
I built, when I was doing the rate, though, I built it all in. Just because you want to compare, you were saying earlier, you want to compare apples to apples. So I didn't want to have a rate that didn't have everything in it. Comparing it, that would be disingenuous.
Well, yeah.
So it's
So
apples to
there's
apples.
no surprises here, something
Yeah.
extra we'd have to
No,
pay?
no. As a matter of
On, in
fact,
our GL or workman's comp or our property, everything's all
got the
inclusive?
property, and I'm going to, property, we're going to get to.
Okay.
Because I'm still working on property, but I'll tell you what's going on there. It's actually interesting. On the general liability, you do not have the same TPA relationship because the TPA you have now is Carl Warren, and Carl Warren has an exclusive relationship with CJPIA, so they don't have staff to manage your claim in Calexico. They don't have the staff, they're in Orange, and they said they couldn't do it. So we went through the process of getting you guys quotes, and what I did was I put in where the average quote cost would be, just to give you a buffer, and
An
you guys
idea.
have the opportunity to pick whomever you want to choose.
You're still
We've given
talking
you
about
guys
the
some
30,000?
options. I'm sorry?
You're still talking about the 30,000?
Yes. So the third-party administrator for liability, you'll need to pick someone and choose from them. You've got a few options to choose from. There's not a rush to pick someone because, A, you don't have that many liability claims, let's start with that. And unlike the workers' comp program where you have to have a TPA in place January 1, workers' comp liability program, you've got some time to do it. You can do it by the end of January when you have your risk management program in place. So you guys can evaluate that at another time.
So, I guess we'll move on to property.
Property. Now, property, you don't have a slide, but I'll tell you what's going on with property. Your property coverage with CSAC EIA and with CJPIA are identical. The reason they're identical is because we're the broker on both sides, and it's the same placement. However, in CJPIA, you're paying $117,000, and you have a $5,000 deductible in your program. And that includes earthquake. So 117,000, it includes earthquake. And what CJPA does is that everyone shares in the same earthquake limit. So you buy a large earthquake limit, and everyone shares it. In CSAC, that's not how it works. In CSAC liability, in earthquake, everyone has their own earthquake limit. So what they said was, we don't have time to get earthquake coverage in the marketplace. They couldn't do it. What they did was they offered you a renewal for property, and you're out of physical damage, and then we have to do the earthquake separately. Right now, you're paying $117,000 all in. The proposal from CSAC is going to be $28,000. Now, their program goes from April 1st to March 31st, unlike the other programs, which are July 1st. So on April 1st, you're going to have to renew your membership in the program, and that'll be another $28,000.
So for now, there will be some type of prorated.
Yeah, so it'll be
cost.
prorated, which will, prorating, so that's $7,000. So it's not, from a standpoint of where your cost, and you can imagine where the cost for property is not in the property, it's really in earthquake. So that earthquake coverage, what we have and where we are now is at about $100,000 for a $10 million earthquake limit, which would be your dedicated limit versus the CJPA program, which is $50 million, but it's a shared limit within CJPA. To go higher, you'd have to pay more money to buy higher limits for earthquake. I'll take direction from the board if you guys decide, hey, Lillian, we want to have a $50 million limit. recognizing that it'll probably cost you another $100,000, but we want to match what we have, then that's something that you guys can do. But
Wouldn't it be wise to maybe see what the city's, liabilities are? I mean, maybe the city doesn't have more than $10 million worth of
you do.
property.
You do. You have $43 million worth of property. You actually have $43 million.
Property that can be damaged by an earthquake,
Well, yeah,
buildings.
yeah, 43 million in buildings.
What about flood?
Floods included,
Floods included?
which is
Okay.
good right now.
We got El Nino coming.
With El Nino coming,
Yeah.
floods included, yes.
Okay.
Yes. So that's your property program. Property program isn't, in terms of driving, the cost drivers, it's a $117,000 program. So you're probably going to be close to that. It's not, in terms of coverages, and the question earlier was, how do we match up? They're the same program. So,
Okay.
on the back end, the brokers are the same and
The
the
same
coverages are
people.
the same. What's different is the retention, the deductibles, and the earthquake limit. So, now, do you have any more questions before I move on?
Yeah, the retention, did you say that the retention fluctuates in the future? Or would, does
No,
that stay?
the retention for earthquake's going to be
For the
different?
retention here, the 250 retention on the self-insured retention? Because the one that I'm a little concerned is the self-insured part of all of this. So what does that 250,000 retention indicate as far as future renewals? Does that ever change, the 250 retention?
Would the JPA say to you, you have to take a 350, or would they say, would they
I
say?
don't have that available, so. I
No,
wouldn't
no,
be-
I'm asking the question, I'm repeating back, I'm going to make sure I'm answering the right question, I'm sorry. So the question you're asking is, my retention is $250,000. So I, the city of Calexico, I'm speaking on behalf of you, is responsible now for every claim that happens in the city, general liability, from $0 to $250,000. And the question you're asking me is, next year at renewal, when you're in the program, can they,
I guess probably the easier way to ask this question is there anything that would trigger an increase or a decrease to the retention?
yes. Similar to what happened with you with CJPIA, if you guys just have a horrible year and you have tons and tons of claims, the committee could vote to say, we want you to raise your retention. Or the underwriters could say, if they're going to be in this program, they have to take a higher retention. And that's no different than, that's kind of, it's back to the same thing earlier with workers' comp. If you perform well, and if you continue to do what you've been doing, you're fine. But if you just all of a sudden just throw caution to the wind, and let's say you have 45 liability claims and you've got tons of things happening, it's very likely that not only will the carrier, the JPA say that, but the carriers will also say it behind them. Because this is all being reinsured by insurance companies, and the insurance companies have some say in, which is why we couldn't, that's why, excuse the frustration, and I understand that. One of the reasons why we were coming in here at the last minute with numbers is because we had to get 6 different underwriters to approve the liability program, the liability rates at every layer, before we could release the number to you guys. So the underwriters do have a say in what's going on, and that's the way it is with every pool. They can make a decision. If they don't believe that you are performing well, they can say, do this or do that. And that's a good question, because it's important to understand that. That's why you see me building in the loss control. I think it's really, really important, and as you're having conversations, it's a requirement of your membership in CSAC, but you really have to focus on loss prevention to ensure that you stay where you are or you improve.
Or we get another PIP?
No, actually, they don't do PIPs. That's not the concept, and there's a slide here they wanted me to make sure I put forth about philosophy of the organization. The CSAC program, they're more risk-focused. They're more of a risk management pool, and it's run more by mostly risk managers. So what they want to do is they'll offer a lot of help. So they build in a lot of loss control services already built in. So you're not going to pay extra for anything, but you get online training. You're going to get access to, for instance, the AIR Law Group, which means that there's an agent. They've actually hired an attorney that's on staff. If you've got a question about a management issue, your general counsel or your city attorney can call them and ask, "Hey, how will this impact insurance? What do you think we should do? What's going on with other people?" So they give you as many resources as you can to help you. And they really wanted me to stress that that's what their agency is about, is to try to help the membership, and they're there for the members. Next slide. Sorry for droning on. I just want to make sure I answer all your questions. So the process that we went through, because we said we started in August, we gathered lots and 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 lots. Did I say lots? Of claim data. They wanted it in a PDF, they wanted it in Excel, they wanted 20 years, they wanted all the claims over $1 million, they wanted all your autos, they wanted to know what earthquake, what happened on the building, they wanted to know about all your everything you guys had. They gathered all, they saw your process improvement plan, all the underwriters saw the process improvement plans. The underwriters reviewed your claim history, they saw your loss runs, they saw your applications, they wanted to know all your policies and procedures. It was rather extensive. Once that happened, they went through a series of committees. The first committee was the underwriting committee, which they reviewed all of your programs to say you could, A, join the pool. And as I mentioned earlier, CSAC has multiple programs. So when you join CSAC, you join the JPA, and then from there, you join the excess workers' comp, you join primary workers' comp, you join general liability, you can join property, you can do one or not, or, you know, they have 23 different programs that you can be a part of. So they then put on the caveats of membership. Your caveat of membership was, A, you had to use a third-party administrator for workers' comp. You couldn't self-administer. And B, you had to have a loss prevention program in place by the end of January in hopes of going towards hiring a risk manager. They also have requirements in terms of your, you have to pass resolutions and join your, and do your other programs. They're going to do a claims audit at the end of the year. And the JPA will have a meeting in February to review that you guys have in place, have indeed put in. They're actually going to call a special meeting in February to ensure you've got the risk management on track, and they'll be meeting with you to help you get that and give you options for that. We went and we asked for the primary workers' comp committee, which is if you were to just have what you have now and transfer and go to a primary program. That program declined your membership and said they wanted you to have some type of self-insured retention. So the self-insured retention was the lowest, which they approved the lowest one. The lowest retention they have is 125, and they approved it. And the requirement was that you had a contract with a third-party administrator. They didn't care who you contracted with, but it had to be an outside agency managing the claims. Then we went to the property committee. The property committee approved you. What they did was they said that for earthquake, if you stayed in their program, your earthquake deductible would be significantly higher. They offered you membership in the program, but your earthquake coverage has to be outside. And then lastly, you went to the executive committee. The executive committee approved you with the caveat of membership, which was listed above earlier, and that is that you have to have the risk management in place and that they're going to do an audit, and they're having a meeting in February. Next slide. Next slide. You've been hearing me mention.
Wait, I'm sorry.
Oh, sure, I'm
I
sorry.
did have a
Sorry,
question.
sorry.
You moved a little fast on that one.
Sorry, I told you, raise your hand, sorry.
I heard you say, but because I used to own an insurance agency, and I did workers' comp. I'm sorry, not workers' comp. I did liability, health, the whole works, and I had my Series 63. So I kind of fully understand, but I've never been in the municipal world, of course, where the self-insured stuff comes in. So I'm trying to follow, okay? When you say that we were declined for the workers' compensation part and that the committee wanted us to do something else.
Primary.
But let's talk a little bit, because I think it's important for our public to understand why we were declined the workers' comp part and why this self-insurance idea is now in play.
The primary workers' compensation program is a first dollar program. And you remember me talking earlier about deductibles, where you have a zero and you pass it off to the insurance company and then they take it on and they manage it. A self-insured retention means that you have from zero to a dollar amount, and then you manage those claims. There actually are not a lot of cities that do primary workers' comp. Most of them actually have some type of self-insured retention, and there are some that I actually work on that have retentions up to $750,000 and $1 million for police and fire. So it's not unusual to have self-insurance in public agencies. Let me just make sure you guys understand. So you're not as though you're some anomaly. It's pretty standard and not uncommon for an agency, a city to have a self-insured retention. And a lot of cities do that because they like to have the control. They want to manage their claims, and they also want to be able to, if they do well, keep the dollars.
If I'm not mistaken, the county is with CSAC, correct?
Yeah.
They're also self-insured.
Correct. Yes.
City of El Centro as well. Okay.
Yeah, a lot of, that's not unusual. But
Jesus.
the question is, why do they say that they wouldn't allow you to be in the primary work comp program? That's your question. And the reason they wouldn't allow you to be in the primary work comp program is because if you look at the losses earlier on, you saw all this fluctuation up and down, bouncing around, and you're running about 50 claims with 176 employees. So you've got what's called a frequency issue. You're not necessarily severity, so you're not having like these big claims that are costing you a ton of money. What you're having is, I'm off for 3 or 4 days, I slipped and hurt my knee, I'm gonna be back in a couple of weeks. You have like death by 1,000 nicks, and they wanted to have a risk management program in place. So they're essentially saying, put a risk management program in place, show us you have control over your claims, and then come back and we'll evaluate you for a primary program. But they wanted you guys to manage your program and wanted you to have a risk management program in place first. So that's why.
So it's due to frequency of claims in the
Yes.
past
Yes.
claims?
Yes. And you mentioned earlier, 50 claims for 176 employees is kind of a
Yeah,
lot.
it's high.
Yeah.
Out of those 50 claims, do you know which one, like, what department is the one that you do? Which
I
department would
stopped the
that
slide before I got there.
be? Okay.
But, yeah, I do.
So that's not something we're gonna bring up today?
But you guys will, one of the things that we'll do as your broker is going forward, every quarter, we'll give you your losses. We'll trend them out with the actuary to see where you're going. And we'll also break out your departments for you so you can see where your claims are happening. So as a council, you can make recommendations and work with risk management.
Because it's almost all in one department.
Yeah,
So,
yeah.
okay.
It is. So now, you have been offered membership, and you all have applied for membership in the CSAC Excess Insurance Authority. And I wanted to make sure you all understood what it is and what it's not. It is not an insurance company. And again, back to organizations and cities and counties and even school districts and special districts in California, the majority of them belong to some type of JPA. California actually has the largest number of JPAs in the country. So much so that California has their own JPA governance organization called COJAPA, and the rest of the country has AGRIP. So you have so many JPAs in California that you actually have your
Have
own
our own
agency.
agency.
Yeah. And almost all public agencies, the large majority of cities, pretty much every county, belongs to or participates with some type of joint power authority structure. So it's not unusual, it's pretty common. You all have been part of CJPA for all the years. There's PERMA, there's SIPA, there's all the other ones. A lot of those JPAs buy insurance from the EIA. So, so you'll have JPAs that are buying and then going into CSAC and then buying excess. So you'll have some that buy at $5 million, and then they self-insure the 0 to $5 million on their own. So it just depends. The membership in California, as I mentioned earlier, they have 55 of the 58 counties. They have 255 public entities, and a public entity can be CJPIA, for example. They're not, but that can be one. Sandpiper was another city JPA. The members are going in now individually into CSAC. And Sandpiper was San Diego, some of the cities in San Diego. It does have special districts. It does include school districts. It does include cities as well as the counties.
One quick question. And all this is overseen by California Department of Insurance, which is overseen by industrial relations?
JPAs are actually not overseen, well, self-insured program for workers' compensation would be overseen by the Department of Self-Insurance Plans.
Not the California industrial
The Department of Self-Insurance Plans is a division of the Department of Insurance.
Okay.
Division of Industrial Relations, that's workers'
Industrial
comp.
relations oversees them.
Workers'
Okay.
comp. That's everything, they oversee every program.
Okay.
Now, for
Department of-
JPAs though, JPAs
Department
are
of
actually,
Industrial Relations.
Relations, yes.
Correct. Okay.
but JPAs are actually overseen by COJAPA. Well, not overseen, but they don't really, COJAPA is California Association of Joint Power Authorities, is the governance, that's what governs JPAs. And then they give accreditation, so you can be accredited, and you can be accredited with excellence. CSAC is accredited with excellence. But there's no state agency that oversees JPAs. Effectively, they're overseen by the Department of Corporations. Next slide. Their philosophy, and they wanted me to put this in there to make sure you guys knew. They want to work with you to get the best resolution on your claims, and so you have a lot of latitude in how your claims are resolved. They allow you to manage your claims all the way through. So even when you hit your $250,000 retention, you continue to keep your administrator and your TPA will work with CSAC. They don't take the claim over once it hits your retention. And that's the same for workers' compensation. So the idea is that a member will come to us, a member will work with us, but we want to give them control over the program, and we work together with them. The other thing is that they will work, they have staff that will work with you for both your liability and your workers' comp program. In workers' compensation, for the excess program, they will actually come and meet with your TPA and oversee your claims. And they're there to give you a second set of eyes to help you evaluate your program to make sure it's on track and to give you assistance. As I mentioned earlier, they want to work with you and to help you. And the philosophy is more that we are a public agency for public agencies, and we want to help them manage their risk. A little different, but I think it's a good philosophy. They will also work with you to analyze your trends and determine where your best programs are in terms of risk retention, loss prevention. I forgot anything. Yeah. Member services is a big part of it. And as a matter of fact, this year, they actually created the member services division to a gentleman by the name of Rick Brush, who will be working with you guys. That was a new position that was just created, and a new department to help reach out to the membership. And the reason they did that is they said that they felt that the members, they had a lot of programs, but the members weren't accessing them, and they wanted to be able to have some kind of conduit to help them know what's available and what they have. Next slide. This is the organizational chart. The members in public agencies control the board of directors. There's an executive committee, and then those are all of the committees that are underneath: underwriting, claims, finance, medical malpractice, general liability, property, health. There's a primary general liability, there's a primary workers' comp, they have a legislative committee, a loss prevention committee, employee benefits, and an internet and technology committee. Underwriting oversees, on top of that, much of the underwriting for other committees like crime and aviation, pollution, cyber liability, so they have different coverages that you can purchase within the program. You, as a member of the organization, can be on any of the committees that are underlying, so if you want to be on claims and coverage, if you want to have a representative on loss prevention, legislative, you can do that. And you also are welcome to attend any of the meetings that they have. They will pay for, their meetings tend to be they have orientations that are in Southern California and Ontario, and then they have regular member meetings every month that you can attend. And they also have board of directors meetings that happen twice a year. Next slide. Excess workers' compensation, and this is not so much about the program financially, but more about the coverages and what you're going to get. As a member, the structure, you all heard me mention earlier statutory coverage. So they actually have two towers, so to speak. The first tower is their core tower, and then they have an educational tower, which just has school districts and the Cal State University system. So all the Cal States and a lot of the school districts in the state, they buy from the educational tower, and the coverages are different because the carrier is different. On the left-hand side, that carrier is Safety National. On the left-hand side, the core program, there are 3 carriers. The AIA has a pool from 0 to 5 million. And then what they do to protect themselves, we mentioned earlier about, and this is also an option for you guys later on as you build your coffers. You know, we're funding our claims from 0 to 5 million. What happens if we're off? What happens if, you know, we have a lot of claims and a lot of frequency and we end up spending $7 million? What they do is they go to the insurance company and they say, okay, we know that it's going to, our actuary says we need to have, and we'll use your numbers, $1.3 million at a 70% confidence level. So we're going to fund $1.3 million, and then we're going to write you a check. And how much would you charge us if we spend more than $1.3 million? We want to give we want to have an aggregate above our claim liabilities. And so they buy protection above that so that they effectively are guaranteeing their exposure. It's something you guys can do later on when you have, you know, when you build your coffers. You can say, okay, we're going to claim liabilities to be $1.3 million, and then we're going to buy an ag stop that limits how much more we spend after that. Above the $5 million pool, they then buy insurance from ACE insurance agencies to $50 million, and then above $50 million to statutory coverage, they purchase through AIG National Union. Next slide. The program coverage, as I mentioned earlier, there is the underwriting committee and the claims and review committee review all the programs, and then they review the settlements. Everything goes to the executive committee, and then it goes to the board of directors. Next slide. The allocation, mentioned earlier, you asked a question about, so it's really not a pool because everyone pays their own cost. This is the first thing. They actually have 3 rating groups. The first one is for counties. The next one is for cities and special districts, and then they have one for schools. So the base rates vary based on the type of exposure. So and if you're a school district, you don't want to be lumped in with counties because school districts don't have police and fire, and those tend to be the more expensive classes. So they actually have 3 rating groups. Next slide. Now, how they allocate costs, they actually allocate it based on a methodology of buckets. So from your self-insured retention, in this case 125 to $1 million, it's based on an actuary. They actually run an actuarial projection for every member in the pool. You all recall when we started this process, we said you need an actuarial study, and you have them done. So you all ran an actuarial study as a part of your membership application. Then they XMOD, we talked about that earlier, how the rate against another agency. So everyone is experience modified based on their performance, and that is applied against the base rate, which is
I'm
then.
sorry,
Sure.
I'm sorry. Did you say that the city needs to provide you an actuarial study?
You did already. You had an actuarial study done. Those were the numbers I used for the comparisons. And you should get some comfort, too, in knowing that you had an independent person evaluate your losses, and you had an independent agency actuarially determine where your claim projections were going to be, and those projections were used to set your rates. So, and that should give you a little comfort in that the question about what if these numbers are really off, because now you're taking on a lot of risk that you weren't taking on before. They've looked at your history, they've looked at your performance, they've looked at your claims over a very long period of time to come up with the actuarial projections.
And that was free, right?
Yeah, it's part of your, yeah. Someone the other day told me to stop saying it was free, because I said something, and she's like, nothing in life is free. Like, she was a client, and I was presenting it, and I was right over, and she tapped me and said, stop saying that. I'm like, okay, so I don't say that anymore. So 0 to 5 million, that premium is also based on actuarial rates. And then the question earlier about what if our frequency is bad and how can we recharge, which is you remember you asked earlier about could our numbers go up or down? This is when they say, okay, well, you have a surcharge because you're having losses larger than the group. And that's where you're going to see a surcharge in your program. And that's from 0 to 5 million. And then from 5 million to statutory coverage, they only apply a surcharge to large losses. And so if you've got a large loss that's over $5 million, in this case, the County of San Bernardino loss, that's where you would see a surcharge applied. The likelihood of you having a surcharge of about $5 million is highly unlikely. Next one. Your responsibility for claims reporting, you are required to report your claims to the agency. Your TPA knows that. They do that now with CJPIA. They will do that now going forward once you do this. There's nothing unusual for them. They know it. They're actually a preferred provider within the agency, within CSAC, so nothing will change. But what happens and what should happen in the perfect world with risk management, you'd have an accident investigation that's done. Let's say I fell when I slipped and hurt myself as an employee. Someone, my supervisor, would do an accident investigation and say, how'd you get injured? What happened? Could we avoid it? Could it be, they'd send that to risk management. Risk management would track all the claims to see where losses are happening and do trend analysis. You then would also be responsible for reporting it to your third-party administrator, who then would report it to the excess carrier if it met the reporting requirements, and they know what those are. And then the EIA would in turn, if it needed to go to their carriers, they would let them know. For instance, I was on a call, 2 days ago with AIG because the county claim could potentially go into their layer. So, next slide. You're going to get some resources with the program. You will get claim specialists that will help you with any of your large losses or anything above your retention. Once a claim hits 50% of your retention, they'll start working with you, giving you advice on settlements, suggesting doctors or anything you like. You also will have claim resources. There's a Best Doc program. There's an ergonomic program. You will have access to Company Nurse. If you guys are using Company Nurse, I believe you are using them now? You are? I think. Are you going to start using them? Okay. Yeah, you call into the Company Nurse. That will continue. They have access to a return-to-work program. You can actually have a person come out and work with you to create a return-to-work program and then manage the return-to-work program for you. They do claims audits every 2 years on your behalf, and that actually is free. Like to say that they're doing that for their benefit, for your benefit, but it's actually to make sure that your TPA is behaving the way it should be, claims are being reported to excess, that type of thing. You will get a medical provider network, which is a pretty big deal. You have one now, and having to change one is a bear. What a medical provider network is do you guys remember Gray Davis? I'm losing my audience, but just, Remember Gray Davis? Mm-hmm. On his way out the door, he was before the recall, he made some major reforms in legislation to workers' compensation. And then, several of those where he changed the temporary disability rates. They limited physical therapy treatments. They limited how long you could be on temporary disability to 2 years before it was unlimited. And then Schwarzenegger came in. And Schwarzenegger also made some changes to workers' comp. And one of the biggest ones that he did was he followed the Arizona system and he created a medical provider network. And what that says is that as an employer, prior to the system, as an employer, you had 30 days of medical control. And then once the 30 days were gone, the injured workers could go wherever they wanted to go to treat. And oftentimes they were going and treating everywhere. They were getting bad doctors. The doctors didn't know the system. And the benefit of workers' comp is that, and people don't believe this, but it's actually true, you want to get the injured workers back to where they were as fast as you can. So workers' comp doctors tend to be better than traditional doctors because they want them back to work, so they go out and find the best doctors. What an MPN does is it says, we're going to give you a list of physicians, and it's going to be every specialty, and they're going to be they evaluate where your employees live, and within, I think it's 30 miles of every employee, it can't be more than 30 miles, they create a network of doctors and specialists. And those are doctors and specialists that you have, and you pay them directly, and a provider network is beneficial to the employer and to the injured worker. It's a really good thing. But if you switch from one to another, you have to notify every employee. And then he has to start at a certain time. It becomes very cumbersome. So being able to keep your TPA in place allows you to keep your medical provider network and not have any disruption with your employees. You also have Medicare reporting requirements. One of the things that the new administration did about 6 years ago is they said, in workers' comp, you would have an injury and a settlement, and then people would take the money, use it, and then they would go to Medicare or Medi-Cal and say, hey, I hurt my knee, I have a bad knee, and they start benefits all over again. They'd have the surgery they never had that they got paid for by the city. Well, what they did was they started Medicare reporting, and when you settle a claim now, you are required as an employer to report the settlement to Medicare, and they track it. And your TPA will do that as a part of the service, and the cost is paid for on your claim file.
So they can't double dip?
Correct. So there's no more double dipping. There used to be lots of double dipping, not anymore. Lastly, ISO indexing, you probably don't notice, but every time you go to an insurance company and have any kind of claim, whether it's an auto injury, a homeowner's claim, a workers' comp claim, or anyone in your household, the insurance companies report that to the ISO Indexing Bureau, and those claims are tracked. So they can tell if you had a car accident on August 14th, and then you filed a workers' comp claim on August 15th, they'll know that, and you're able to know who the doctor was that treated the person. It's all filed, and so as an employer, you're able to get that information back to be able to figure out and use it to settle your claim. Go for it. Next slide. General liability. Next slide. The structure is a little different. You have 0 to 5 million, which is a pooled layer, and then above that, you layer it up. And remember I mentioned earlier the different carriers. You can see there all the carriers that are on the program at the different retention levels. They do reinsurance of 10 million, 5x of 10, then they do reinsurance again to 15, then they do reinsurance to 25. And then above that is another program called the Catastrophic Liability Insurance Program, which is from 25 above 25 to 50 million. Program governance and general liability is the same. You've got an underwriting committee, and you've got claims and coverage, then it goes to executive, then it goes to board of directors. The features of coverage in general liability are auto liability coverage. You have a broad definition of covered party, so it covers past and present board members, volunteers, and employees of the city. And you have your choice of a third-party administrator. You will have to choose an administrator, but you have the choice of choosing whoever you like. Another really good feature about the program is that the claims administration costs are assigned to the claim file, so it helps to erode your self-insured retention. So once the file gets into excess, you can say, hey, we spent $25,000 on TPA costs, and that is part of your self-insured retention. Claim reporting for them, you're going to have an incident, which is reported to you. You then will report it to the EIA, and then you will report it to the excess. They will in turn report it to the excess carriers, exactly the same as in workers' comp. Your resources are similar. You'll have the ISO reporting. Medicare is also required in general liability. You will also have claims audits. You have the same resources available to you here, and you have the same structure for your claims operations. Property. This is a pretty gnarly chart, and the reason it's such a big chart, they actually have one of the largest property placements in the U.S., and it's done both domestically and in Europe. The coverage has, what they do is they layer the program with different, there's 7 towers. They buy limits up to $600 million per occurrence. So if you were to have, in your case, a full limit loss, meaning every building in the city was destroyed, you have coverage for the program. And then they layer it across with what's called rooftop coverage, which every member gets their own earthquake limit, as I mentioned earlier. Next slide. Workers' compensation has, property has very broad sublimits. You've got 450, you asked about flood earlier. You've got 450 million in flood limits for critical first flood. That means flood zones A and V, which are high hazard floods, and generally you have to buy that coverage separately. It's a manuscript form. I mentioned earlier it's the same form you have now, so no difference. And they've been with the same carrier for 29 years. You have, which is a nice feature, you have automatic acquisition. So as you're building or you're growing and you add buildings, those buildings are automatically added as long as they're below $100 million in value. Next slide. As an example of how they break the property down, they move, if I were you, I wonder, well, it's such a large program and they're up and down the state, should I be concerned about, a big loss blowing through and taking out $600 million? And what they do is they actually put different counties together in different areas so that they don't have a loss eroding or a $600 million per occurrence loss hitting all the members at one time. They do 7 different towers. So think about this. I'm going to have a tower, you're going to have a tower, you're going to have a tower, you're going to have a tower. So that way, if I have a loss, or your loss isn't going to erode and take out everyone in the program. They limit the exposure for everyone, and they do it 7 times. That's to your benefit because that allows you to have the confidence that the program won't have a large loss, let's say a big wildfire or something that comes through and takes out 2 or 3 counties or 2 or 3 cities. And think about like the rim fire, or those big fires you see. You want to have some separation so that the layer, it re-ups every time. Governance, the property program is governed by the property committee. They review all matters regarding the funding, the coverage, the claims, and all the member services, and all the member applications. Next one. It includes all risk. It includes personal property, real property. So real property is your building, the actual structure. Personal property are your chairs and desks. Business interruption, let's say you had a major loss and you couldn't have your meetings here, and you had to go rent someplace to have a meeting. That's an interruption of your business, and that's an additional cost that you usually have to incur. It's included. Rental values, if you have to rent something because you need to rent new mics or you need to rent chairs or whatever. Extra expense, you have to have an additional expense now. You have to bring consultants in because you lost the use of something. Boiler machinery coverage is another coverage that's included, which I like to say it's if you've got any boilers in your city, it covers those. Course of construction, should you start building and doing any renovations or buildings, this is included. Oftentimes, builder's risk or course of construction coverage is a separate coverage you have to buy on your own, and it tends to be about 3 or 4 times more expensive than traditional property coverage. It's included. And lastly, the question about terrorism. Let's say someone decides to blow your building up, God forbid, you would have coverage for that as well. It also includes coverage for specially trained animals, so your police dogs are covered as property, and that may seem strange, but
They're expensive.
they're very expensive, and you don't want to have someone tell you, oh, sorry, you're going to have to train a new dog, and we're not going to pay for that. So the dogs are covered as property, and they're included. Fine arts, asbestos removal and cleanup, business interruption, accounts receivable. If your property is moving from one location to another and something happens to it, let's say it's your computers are driving from here to there, and someone breaks the truck and takes them off the truck, or you spill and has a damage in your car, and the property's inside the car, property and transit is covered. Electronic data processing and media, so those are all your computers and all the stuff like that's covered. Valuable papers are covered. Also, cyber liability. You keep going. You can cover contractors' equipment, which is included in your coverage. You guys gave us a number, so we included it. Vehicles, which are included in the coverage. Earthquake was not offered, but we're going to place it separately. You have the option, if you guys choose to, and maybe you want to consider it a renewal, you can upgrade to green. And what that means is that you have the ability to, if you're doing green building, LEED certified construction, and you are a silver, you can upgrade to the next level. Or if you purchase it and you don't have LEED certification, you can go to the silver level. And then finally, if you've got fine arts, we have some cities in Northern California that they actually have gold from the gold rush days on display at the city. It's considered fine arts, and they have expensive paintings, and so you want to insure those as well. Workers' compensation, and back to that again, your requirements are that you must hire a TPA. They will do an audit every 2 years, and the claims have to be administered in compliance with the EIA standards. Go ahead.
On the guidelines, can we find that on your website?
I'm sorry.
On the guidelines, can we find them on your website?
Yes.
What's
Yes.
your website?
Yes.
Oh, it's the one
And
that's here, the CSAC.
Actually, yes, you go back. This is the website.
Yeah, you have a page here.
Yeah, csaceia.org, and on that site, you can, all of the guidelines and all the coverage documents are forward-facing, so anyone that's interested in going online to see them, you can. And in addition to that, you'll have a members-only area that'll have your financials and your cost of insurance and those types of things. But the coverage documents, all the resources, loss prevention, all of those things are they're forward-facing, so you can see them. They also have an interactive application that allows you to do online blogs with other cities if you want to ask questions about how they're doing something or how they're managing this risk or what they're doing with this exposure, or any of those things you can ask, and you can have that available to anyone, or you can limit who it's available to as well. Next slide. Property program, I think I did that already. I'm sorry. Keep going. I repeated myself. Oh, I'm sorry, this is important. Your responsibilities as a part of the property program. You must maintain your statement of values. So your statement of values right now say you have $43 million in buildings and contents. You're required to make sure that information is accurate. And every 5 years, they will come out and do an appraisal for you as a part of your membership in the program. It's included in the program for any building that's valued more than $1 million. You must notify them if you have a loss. You may not have a loss. Let's say, for instance, you've got water damage, and then you fix it, and then a year later you call and say, hey, last year we had a loss, and or even 3 months later. You must notify them when there's a property claim. Your deductible is really low, so pretty much any property claim, you're going to want to call them and tell them about it. There's a proof of loss statement. Once you have a claim and you all agree on a settlement amount, you have to sign off on the proof of loss and return it back to them. You will have to be responsible for paying your deductible, and you are responsible for protecting and safeguarding your property. So you just can't leave the doors open and then be surprised if someone steals all your stuff.
Usually, in order to settle these things, there needs to be legal representation. What is the usual that other cities do when they're self-insured for workers' comp? Who do they hire for their legal representation? Is it an independent legal firm, or is it the actual city attorneys that usually handle all of that?
In workers' comp, it's going to be an independent legal firm. On liability, it can be the city attorney, and a lot of cities use their city attorney. You can do either one.
I believe the city uses Lieber Cassidy as
Yeah,
as
Lieber
our-
Cassidy does a lot of stuff for a lot of cities. Next. I mentioned these before. The big thing right now for everyone is about flood, because we're talking about El Nino, and as I was driving here, it was crazy scary. So flood is included. I want to make sure you guys know about this coverage. This program allows you to repair, it's called repair replacement costs. And you see this commercial all the time when they're talking about Allstate, and she's talking about, oh, my car, and I drove off the list, and I got off the lot, and now they're telling me that I don't have, it's not covered anymore, it's not as much, so I lost value. Most policies have what's called actual cash value. And your auto policy has actual cash value, which means it's the cost of the vehicle minus depreciation. Once you drive off the lot, it depreciates. Your coverage here is going to be for repair and replacement costs for your buildings and contents. So whatever it costs to repair and replace it, there's no actual cash value. And on your autos, you can do either actual cash value or you can do replacement costs. And that's based on how you report the values. If you report the values at actual cash value, that's what you'll get. If you report the values at replacement costs, that's what you'll get. And they'll ask you at the time of the loss, is this actual cash value or is this replacement costs?
So just an example, if the city has a street sweeper that's worth $100,000 because it's kind of old, but a new one is $300,000,
Correct.
and it blows up,
Correct.
terrorist bombers. The city could put an insurance claim for replacement and
Correct.
get the $300,000 for a new one
Correct.
versus just asking for $100,000.
Correct. The only caveat is that you have to have that street sweeper on the schedule valued at $300,000. You can't have it on your schedule valued at $100,000 and
Understood.
say you want a $300,000 replacement.
Okay.
And the example you gave of the terrorist blowing it up, that does, actually is a good example, that is covered, but it won't be for, if it blows up because you didn't change the oil.
No, yeah.
Yeah, I just
obvious-
want to make
yeah.
sure it has to be, I have one of my clients, and she's on video, so I can't say her name, but.
Yeah, if it catches
it's a-
fire for deferred maintenance or anything like
Yeah,
that. then
deferred
it's-
maintenance not covered, but she's a city, a large city, and they just went through police cars. I mean, they were just crashing into each other, and we were replacing cars left and right. On cyber liability, the quote that I gave you, $28,000, did not include cyber liability. The side liability premium is another $1,032 at a $50,000 retention, and at a $5,000 retention, it's about another $5,000. And the other thing that's really, this is just information about the program. What I will tell you is that I mentioned earlier, you'll get appraisals of your buildings that are over $1 million, and they'll do it every 5 years, which will help you manage your, to ensure your buildings are properly valued. It doesn't matter, you do have replacement cost coverage, but this is just an additional thing to make sure if you're questioning whether or not we have the proper values, this is there. And they also, in the property program, they give you a third-party administrator, so you don't have to contract with someone to do it. Not a bad thing to have your TPA manage both, because they're managing your fund and your retention, but they will have, they do give you experienced examiners. And McLaren's Young, just to tell you who they are, they have agencies across the United States, and actually outside the United States as well, and they were the ones that did the World Trade Centers. So they're a very large agency with lots of offices. Exclusions?
The new ones or the?
I'm sorry?
Not the old ones, right? The
Not
ones
the-
that fell.
Actually, the old ones. So exclusions, unless you buy them back, are aircraft, watercraft, which you guys don't have either, actually. Rolling stock, which you don't have either. Standing timber, you don't have either. Growing crops, you don't have either. Animals, which we put back in, if you schedule them. Land and land values, and this is across the board for insurance. Insurance companies don't insure land and land values. So when you have a loss, people will say, my house is worth, $200,000. No, your land and your house is worth $200,000. Your house is worth $65,000. The land is worth $135,000. So it's important to understand land is not covered under insurance. It never will be, because it can't be damaged. Large construction projects, let's say you decide to do major renovations and you do anything that's above $100 million, that is not covered. You have to buy coverage for that. So the construction coverages that are under $100 million are covered in the program. Over $100 million, you have to buy another policy. Power and transmission lines, you have to schedule them onto the policy, otherwise they're excluded. If you have power and transmission, if you've got railroads, that's not covered, and that's across the board. No policy covers that.
What about our airport?
If you schedule the airport, it's covered. You have buildings on the airport, that'd be covered. Now the actual airplanes, I don't think you guys have any, but if you had airplanes, that would be an aviation policy, and that would be hull and aircraft. But the actual buildings on the airport are covered. And then lastly, unscheduled dams, piers, walls, docks, underground piping, and infrastructure is not covered unless you put it on your property schedule and say, we have a pier, and this is the value of the pier. You just can't say other and then say, oh yeah, we had a loss and the building included the pier. No, you have to tell them what it is. Next slide. We talked about this already, so we'll move on. This is information about McLaren's Young and their phone number. I didn't mention this earlier, but one of the things Alliant will do as your broker is we actually have a claims advocate. His name is Bob Fry, and Bob's responsibility will be in the event of a large loss, or a loss in your case because your deductible is so low, he will help you deal with the insurance companies and be an interface for you with the third-party administrator to help you navigate the policy form, because property policy forms are like 300 pages long. There's lots of nuances in them, and it's good to have someone that understands the form that can help you and be your advocate on your side dealing with the insurance companies. Your membership requirements, we talked about those earlier. You are required to do a membership agreement to join the JPA. You are required for every program that you're joining, which would be general liability, excess work comp, and property. They have memorandum of understandings about how you're going to report claims and what you have to do. You have to sign that. You have to designate an official representative to deal with the EIA, to get the bills and process payments and things like that. You have to also give them authorization to obtain your data directly from your third-party administrator. You must get your certificate to self-insure from the state of California, and you must, of course, pay your premium. Next slide. I think that's it. We talked about free of charge, so there you are. These are the things that are available to you. You have online training, webinar training, on-site training that they'll give you. They have a video learning library, and then they do consultation. Those are all included. You can also there's some DOT training that's required, and also some police and some EMTs have certain types of training that they have to have. They have it contracted rates for that. They have a pull notice program, which is included, but they also have a drug consortium program, which is an additional charge if you want to do drug consortium for all of your required drug testing. And then if you want them to help you with writing out policies and procedures, they'll charge you for that, but then they give you a $1,000 loss prevention fund that's already built into your premium. Next slide. $1,000 membership fee. They include in your program, for each of the programs you're joining, they're giving you a $1,000 risk management subsidy. You can add more to that if you'd like. For instance, if you say, we know we're going to spend on loss control consulting, and we want to run it through the JPA, you can say we're going to put $50,000 in risk management, and then you can pay all of your stuff out of the risk management fund, a loss prevention fund. That will be controlled by your designated rep, and it allows you to have some flexibility with being able to get payments processed quickly. I believe. Or you can find information, we talked earlier about the EIA website. On the website, you would have information about all of your coverage documents are going to be there. All of the documents of membership will be available online. You are required oftentimes to issue certificates of insurance to other individuals that you're doing business with. Each of those will be available online as well. Copies of all of your applications are available and will be held online for you so you can see that. Anytime you add or change who is covered under your policy, oftentimes you might be asked to add someone on the Friends of the Library, or you may extend out coverage for something like that. Those are also listed there. And every request that's made for reimbursement from the subsidy fund is listed, and who made the request is available, so anyone can see it. You also have what's called the Essential Link. They will send it out once a week. Anyone that's here that wants to be seen or copied on it will get a copy of it, and it's everything that's going on with the EIA and all the essential information. You won't get emailed from them all the time. What they did was the members complained they were getting too many emails, and so they created the Essential Link. Once a week, you get all the information in one place, and you can read it. They have blogs that you can be a part of that will, for city managers or for risk managers or people that have questions about this or about, and you can ask questions about pull notices. And they have a message board that members can interface with each other to ask questions outside of the EIA. Next slide. Alliant. Our motto is please. So we place insurance and reinsurance for our members. We liaison with public entities. We enlist new members in marketing for the EIA, which is what I'm doing here. We answer any questions that you may have. We serve as a consultant. We are, in our mind, we serve all of your needs, and we evaluate alternatives and recommendations for you. And we're pleased to have the opportunity to work with you. Thank you for your time and any questions that you may have.
I just want to, Lillian, I want to thank you for helping us out. I know that, when I contacted you back in August and we had exchanged some emails, the city was going through some issues with our insurance, and so I felt that we needed some type of backup, and which I really think that in reality, I shouldn't have been the one contacting you, but maybe the city manager should have, or the city itself. But that said, that's in the past. I know that we were CJPIA did give us the information that we needed to start off, but I really want to say that I'm really sorry for the past administration, because they did block giving information to go ahead and speed up this process in the past, and I thought that was wrong, because we could have had you guys on board maybe a month or two ahead of this without having to be so, if we don't have it by January 1st, we're in trouble, and I think that the last administration for doing that was wrong, but I'm glad that you're working with Liliana and Mr. Finley, and we finally got this done. And once again, I just want to thank you very much for all your help, and say I'm sorry for what happened with the past administration. Thank
I
you.
appreciate the opportunity. I thank you very much for your consideration. I thank you guys.
Thank you.
Actually, excuse me. Actually, we contact you, we believe about August, and unfortunately, the former staff, they supposed to find other insurance options. They put the hostage on it. So that time we council approved Mr. Real and I to committee member to contact the insurance company. So we had contact other JPIA, and they were turning down, and Mr. Real was contacting you to get information. But since once we got the information with you, and we couldn't get the information from the JPIA, and even we sent all the information to you, and you asked us to get the 10 years experience, things like that, and we have formal administration, we cannot ask them to deliver. We were looking into how we're going to be maneuvering to get the information from the JPIA, because we had the problem to getting the full report, and we're going to get the trouble. At that time, we had the administration changed it, and Mr. Finley, I we sent to Mr. Finley to contact you, and we are processing the most high speed. I'm very grateful to Mr. Finley and you working together to speed up to all the lost time to cover up. And well, hopefully we starting for the better relationship, and also I believe this starting point is for us like a costly, but next year we're going to be reducing our cost. Plus, it depends on how we function to ourselves, so we can reduce a lot of our commitments. Plus, whatever we commitments there, as long as we don't use it, that means we're going to have another savings there. Even we cost us right now a lot, and I believe there's going to be savings for the future because we don't spend it.
Correct.
Yeah.
I think it's important, because I said something earlier, and I want to correct myself. You made a comment about process improvement plan. You said they could give us a process improvement plan, and I said, well, no, they wouldn't do that. And effectively, they have, because they've said, we're going to give you self-insured retention, and you're going to manage your own claims, and we want you to have a risk manager in place. We want you to have a third-party administrator. So in my mind, I guess, if you think about that, is a process improvement plan, because it's something you haven't had before.
There's stipulations that they're asking for,
Yeah.
and
Yeah.
my understanding is the previous improvement plan was pretty much met. I mean, there's like 90, I think
Yeah.
there was one thing missing out of the whole PPI, so I think you said that they were happy with what had been
You
done.
guys have, I think you're in the process of doing lots of policies and procedures, which you still should continue to do. It's good risk management. And those are still in process, and I think you should continue to do that. And when you bring on a risk manager, that person's responsibility and role would be doing that for you.
Yeah.
Okay, any council members? Questions?
I thought that was a great presentation.
Oh,
Thank you for
thank you.
coming down, and thank you, Mr. Finley, for providing us all this information. I have nothing else to say.
Thank you. Okay, let's, yeah.
Yes, I want to thank you, Lillian,
Yes.
for you did a great presentation.
Thank you.
And also, I want to thank the mayor and Councilman Member Real and also the administration, because we finally, with the help of the majority of the council, make it happen to look for some good brokers and insurance like you. And I believe this is one of the best solutions for the city of Calexico. Again, thank you.
Oh, I
You
appreciate
did a great job.
Thank you.
Okay, before we go to this another items, and then I have my apology to the media, because we thought we're going to finish by before 2 o'clock. We will call the press conference.
Never give me
So
a
it looks
mic.
like we're going to be around 3 o'clock. I'm sorry. I'm very sorry about that time lapping. Mr. Eduardo Garcia, I was inviting him to 2 o'clock to join us the press conference, but I'm sorry. I think they have it on the schedule. They left. I'm sorry to the Mr. Garcia. They will come here to supporting us to our getting insurance. Our time calculation was wrong, so that's happening. Sorry. Thank you.
Never underestimate this council, okay? Always go over.
Thank you.
I will make the motion to approve item number 2.
Second?
Wait a minute. We're not done yet. The program about the presentation.
Presentation is done, yeah.
So this one just only number 1 is only presentation, nothing to approve it.
Sorry, actually,
The number 1
3,
presentation.
I'm sorry, number 3.
It's recommended that the council approve the following CSAC and Excess Insurance Authority programs, A, B, and C. Is that correct?
That's correct. We can either, one, just take the programs individually, or we can actually move all the items at once, too.
We'll just do them as a
well,
whole.
Since I think the
Each
staff report,
individual
that was
better?
for all the items inclusive, so you
Inclusive.
could take them on one motion. We would just need to confirm the options that were presented for both the general liability.
I would
and
like
the
to
workers'
hear the
comp.
city manager on the options, if he believes that option 1 on both GL, general liability, and workers' compensation is, I think we follow your lead on what you believe is going to be the best option for us.
I would recommend that we take option one on both the general liability and workman's comp.
Option one, okay.
Option one.
So I make a motion to approve with option one on general liability and workman's comp
Second.
for all resolutions.
Yeah, so that would be
Aye.
for items 1 through 5 on the agenda.
1 through 5. Aye.
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 No.
Wait, Lenny needs clarifications for the, we approving whole agenda? or
Yes.
With the option one?
Option one, yes.
Okay.
Are
We
you
have
voting, are you voting yes or no? Aye.
I say yes.
Well, do we have any council members of that discussions?
Not me.
No discussion, Mayor
No
Kim.
discussions? Okay, we can vote?
Aye.
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 On item number 2.
This is
Mr. Hurtado?
all five?
All five, yeah.
Correct.
Okay.
It'd
Adoption
be
one.
for approval of the 5 agenda
Miss-
items
Ms.
with
Hurtado?
You're going to group them all
options to
together?
vote.
It's no on all of them. And the reason I'm saying that is that I believe that it's a very uncomfortable decision to go self-insured at this point, being that the city of Calexico has their finances in disarray.
Thank you for your opinion. So Mr. Hurtado noted the no. And Mr. Leal? Yes?
I voted aye.
Okay, yeah, thank you. So we approved the agenda, and thank you for the council members, and then a Merry Christmas for our staff, and the Merry Christmas to the City of Calexico.